Howdy, Jacob here. Today we're looking at Enphase Energy, company in the semiconductor and semiconductor equipment industry with 16 billion market cap and a little bit less than that enterprise value. They've been around since just 2006 and already a $16 billion company. Pretty impressive here. Growth is also pretty impressive. 344 million back in 2014 up to 2 billion, 2.3 billion in 2023 with margins on the operating side going from negative to as high as 20%, and then growth side going from 33 to 46% in return on invested capital of 20%. Pretty substantial there. Let's look at this income statement. So shares have been growing like crazy over the last 10 years, but in the last 4 or 5 years, very much more stable share change. So there's probably a mix between stock-based compensation going down, and then maybe they're buying back some shares as well. But like I said, net income growing from negative to largely positive, or a huge amount positive. Gross profit, huge growth. Revenue, huge growth. Balance sheet, 1.3 billion in long-term debt, no short-term debt, and 1.7 billion in very liquid assets. So very healthy balance sheet where their cash equivalents and short-term investments is greater than their long-term and short-term debt. That's substantial. That's a positive sign. Use of cash, very heavy on stock-based compensation, reinvesting, which is great at that 20% rate of return, and then a little bit in acquisitions. So great to see that they're not buying a dividend or paying a dividend, and their debt isn't so substantial that they need to pay it down, with the fact that they have cash and equivalent and short-term investments greater than their debt. So really what I'd be doing is it almost exact. I mean, I don't know what price they're paying for this stock, so that would change what I would do. But the use of cash, a little bit in acquisitions when it's advantageous to you to maybe have some margin expansion, and then absolutely reinvest back in yourself and buy back shares where you can get that humongous rate of return. Their stock-based compensation has grown immensely, so they are buying back shares a lot more than they used to, but they got about 213 million per year in stock-based compensation. That could help though with their insider ownership, 3%. Yeah, that's something. And again, that's just Yahoo Finance, so that it could be different if I were to look at the 10K. But right now, I'm ready to start making some assumptions here. So growth has been absolutely crazy. I will probably slow it down a little bit compared to what we're seeing here. I think that for this company, 15% is pretty reasonable based on the fact of I think the semiconductor business is really growing like crazy, and I think that I could absolutely see Enphase grow at a rate that's above what the semiconductor rate of growth is. And so um, margins, I'm not taking, what is this, 12? Is that true? 12 billion. Okay, this 0.12. Oops. All right. Little user error there. Okay, so growth in the margin side has been growing. Maybe let's do something along the line. And I love that free cash flow is higher. And but that is based on stock-based compensation. That will come into effect with the share change. But earnings margin, let's do 20 and 25% for earnings and for cash flow margin. Increase the shares. Let's do flat. Let's say that they do buy back as many shares as they're issuing through stock-based compensation, and then terminal PE. I mean, at the end of 7 years, this will make them a 6 billion market cap, or 6 billion in revenue, which is large but not extraordinarily large. So probably still growth there, and then 15% return. Honestly, to me, it's a bit more reasonably priced than some of these other companies that we've been looking at. I would say that this growth is definitely dampened from, if you're looking at the last 5 to 10 years, but you got to be realistic that the bigger a company gets, the harder it is to grow. And then two, um, I just have more conservative P price free cash flow than most people. To me, I'm looking at the end of 7 years. What is going to be the growth rate? What will be the possible moat in that for that? And so, I mean, it's very tough for me to do anything higher than 20, because that would be assuming that they have double digit growth for the next couple of years ahead of them, which is just tough to look that far out. So I definitely try to be conservative on that end. But honestly, numbers look fantastic. I would want to look further into this when it gets to a more attractive price, and it looks like 39%. I mean, that sounds pretty far off, but I think it's pretty reasonable uh, to do a deeper dive in. I think stocks move so incredibly much that honestly a 39% decline is really pretty reasonable. So hopefully you enjoyed the video and have a fantastic rest of your day. Thank you.